when selecting a strike price in the money for buying a call, how much in the money should it be? This is actually quite a tricky question, but for the audience out there, there are a couple of different rules of thumbs. Um, First of all, you want to buy a leap. Typically, look for a delta of 0.55 to 0.75. And also, you got to look at exactly, you got to do some modeling around the Black-Scholes. Is the option overpriced or underpriced based on volatility or expectations? And they are very key factors to look at. Also, you got to look at the volume, and it's a tricky thing. I probably need to do a more detailed dive on this. But the key thing for me is to identify the sweet spot. You mentioned call option, leap option. I like to have, first of all, if you look at this is the blue line is the call delta. Sometimes people call it the hedge ratio, and it indicates the sensitivity of price change of the underlying asset to its derivative instrument. And delta measures the degree to which an option is exposed to shifts in the price of the underlying asset. Now, as you know, with me, I like when things are very, very volatile to either buy or sell. So a huge crash, you got very expensive put prices, and I sell them and I use the money to buy calls. And then if there's a big spike upwards, calls will get very expensive and I sell them out of the money to make money to cover my downside. So that's kind of how I look at it. But the sweet spot is all depends on the asset, how volatile it is, where it is, how it's priced. And you can see here, always buy in the money when you're there. Again, with the delta ratio that is out there. And also don't buy anything less than a year for multiple reasons: taxes and time. The more time you have, the better the option has a chance of being successful and profitable for you. There's one of the things important to mention is kind of like delta, what happens to it over time based on the days to expiry. The delta goes to zero, everybody. So remember that as you go forward, and that will be clear because the change in value of the delta is not linear, except when the option is deep in the money. I have a lot of deep in the option monies, deep in the money options, and then you see the delta go completely to zero. But always buy. So, for example, if you're looking at, imagine Google's at 2,700, try get the $2,500 call. Call option might cost you $400. You'll be the easy rule of thumb before you start looking at all this stuff and calculating your deltas is start with a half time value, half intrinsic value, and then take it from there. Hope that helps, but there is no fixed rule of thumb. You have to look at everything and all the factors around exactly how the position is trading.